Okay, let's be real. Candlestick charts can look like confusing barcode spaghetti when you're just getting started. But what if I told you every candle tells a story? One candle might whisper that the buyers are in control. Another could scream, "Sell now, this thing's about to drop." In this guide, I'm going to teach you how to read candlesticks from the basics to the juicy, game-changing patterns so you can actually understand what's going on. By the end of this video, you'll be able to spot reversals, trend shifts, and price momentum like you've got X-ray vision for the market. And don't worry, we're keeping it clear, visual, and beginner-friendly, no boring lectures. This is more like sitting down with a trading coach who's just as excited to teach as you are to learn. Let's get started. A candlestick is a visual snapshot of what happened to a stock's price over a specific period of time. That time could be 1 minute, 5 minutes, an hour, a day. It is totally up to you and your chart settings. Each candlestick gives you 4 key price points. Where the price started, that's the open. Where it ended, the close. The highest point it reached, the high, and the lowest it dropped to, the low. It's like a tiny storybook about price action packed into one little shape. If the price closed higher than it opened, you'll usually see a green candle. That means buyers were in control. That's a bullish candle. If it closed lower, the candle is red, bearish, and it signals that sellers are running the show. The thick part in the middle, that's the body. The thin lines poking out the top and bottom are called wicks, or shadows, and they show how high or low a price moved before settling back down. Now let's zoom in on something super important, the closing price. The close is where the price ends when a candle's time is up, and it's a big deal. It's like the final score in a round. Sure, the price may have been all over the place, but where it closed tells you who had control at the finish line. Did buyers keep price elevated? Did sellers drag it down at the last second? That closing price carries weight, especially on longer time frames. Let's simplify this further. Who are the buyers and sellers anyway? Buyers are people, or institutions, or bots who believe the price is going up. They're placing buy orders, hoping to catch the move early. Sellers are the opposite. They either think price is going down, or they're cashing out their profits. And when their forces collide, that's what creates a candlestick. Every candle you see is the result of buyers and sellers battling it out. The direction the candle moves, that tells you who won the round. The wick shows where the other side tried and failed to take control. Reading candlesticks is all about figuring out who had the upper hand and whether that might continue. And there's one more piece to this puzzle, and it's called time. Remember how each candle covers a certain time period? You can switch the chart to any time frame you want, from 1 second to 1 week. A 1-minute chart shows candles forming every 60 seconds. A daily chart forms 1 candle per day. The same rules apply, but the speed and the zoom changes. Now that we've got the basics down, it's time to dig into the candle patterns that traders use every day. Let's start with one of the funniest looking ones, the doji. A doji is what shows up when the market shrugs and says, "I don't know." It forms when the open and close are basically the same, meaning price went up and it went down, but then settled right back where it started. That's indecision. A little tug-of-war with no clear winner, but not all dojis are built the same. Their shape actually gives you extra clues. The classic doji looks like a tiny plus sign, a skinny candle with small wicks on both sides, and no real body. It's your standard wait and look signal. You'll usually find it near reversals or breakout moments, like a pause before the big move. The dragonfly doji looks like the letter T. It's got no top wick, a long bottom wick, and the open and close are at the top. This one shows that sellers tried to take the price way down, but buyers fought back and brought it all the way back up. That's bullish energy. If you see this after a downtrend and the next candle is green, that's a big green flag, and it signals that an uptrend is imminent. Now, the gravestone doji, that's the opposite. It looks like an upside-down T. No bottom wick, long wick up top, and the candle closes at the bottom. This one says buyers tried to push the price up, but got rejected. If this shows up at the top of an uptrend, that's a red flag, and it's a sign that a downtrend is imminent. Now, the long-legged doji has long wicks on both sides and a tiny body in the middle. That's major indecision and usually leads to volatility. Price was all over the place, up, down, back again, and still closed flat. The rarest of them all is the 4-price doji. It's just a dash. Open, high, low, and close were all the same. It means absolutely nothing happened. You'll see it in slow, low-volume moments when the market's basically asleep. Bottom line, dojis are like a yellow light at an intersection. Not a signal to go, not a signal to stop, but definitely a signal to pay attention to what comes next. Now let's talk about the plot twist candles, the ones that show up just as the market is about to flip the script. First up, the hammer. Imagine the market's been falling. Everyone's panicking. Then suddenly, a hammer appears. It's got a small body near the top and a long wick hanging below, like it just dropped the mic. That long wick means sellers pushed the price way down, but buyers came in and shoved it right back up before the candle closed. That's a classic bullish reversal signal. It's buyers saying, "We're back." Especially powerful if it shows up near a support level, and even stronger if the next candle is green. Then there's the inverted hammer. Same energy, but flipped. Small body on the bottom, long wick on top. It also shows up after a downtrend, and it means buyers tried to reverse the trend but couldn't fully hold the gains. Still, it's a sign that something might be shifting. Watch for confirmation. Now flip that inverted hammer and move it to the top of a chart. You've got a shooting star. Looks just like the inverted hammer, but the story changes completely. Now it's sellers rejecting higher prices. Buyers pushed the price up, but couldn't keep it there. If the next candle is red, that star just marked the top. Those are the heads-up candles. They won't always mean instant reversal, but they absolutely mean something shifting. Now let's get into some bold, two-candle patterns, engulfing and tweezer setups. A bullish engulfing pattern is when a small red candle is followed by a big green candle that completely swallows it. It's buyers stepping in and saying, "We got this." These are most powerful after a downtrend, especially at support zones. Bearish engulfing flips it. Small green candle, then a big red one that takes over. That's sellers flexing. Watch for it at the top of a move, especially near resistance. Tweezer bottoms and tops are simple, but effective. A tweezer bottom happens when two candles, usually one red, one green, hit the same low. Price tried to break down twice and failed. Buyers are holding that line. It's a sign of strong support. Tweezer tops do the same thing but in reverse. Two candles with the same high, green then red, signaling sellers are defending a level. It's resistance, and it could mean the trend is weakening. Let's add more drama, the three-candle patterns. The morning star is a reversal setup. First you get a big red candle, sellers in control. Then a tiny candle, indecision. Could be a doji. Then a big green candle, buyers have taken over. It's like watching a trend fall apart in 3 acts. The evening star is the opposite. Big green candle, buyers in charge. Tiny indecision candle. Then boom, a big red one. That's your top. Sellers have taken the wheel. 3 white soldiers are 3 strong green candles in a row, each closing higher. That's bullish continuation. Momentum. Power. 3 black crows are 3 red candles dropping step by step. Bears in full control. It's the start or continuation of a downtrend. Now for some bonus candles. Maribozu candles have no wicks, just a full body. If it's green, buyers own the entire session. If it's red, sellers did. These usually show up during breakouts with strong moves. Pure momentum. An inside bar is when the whole candle fits inside the one before it. It's a pause, price is catching its breath. Traders often watch for breakouts here. An outside bar breaks both the high and low of the previous candle. It's volatility. Could be a strong continuation or a fake out. Always read the room. And now guess what? That's your full candlestick masterclass. You've learned how to read each candle, what it's trying to tell you, and how to stack them into patterns. But remember, candles don't live in isolation. Always use them with support and resistance and indicators like RSI and MACD and volume. Practice spotting them. Look at old charts. Watch how they form in real time. Once you start seeing these patterns everywhere, you'll never look at price the same way again. If this helped, be sure to like, share, and subscribe, and check the description to join my real-time alert channel where we use these same patterns live. Let's trade smarter, one candle at a time.